Hey everyone, let's talk about investments. We'll wrap up our discussion of fixed income with considering what we can do about interest rate risk and how we can manage it. We already know that the term structure of interest rates can tell us a lot about expectations for risk in the future, but that these expectations are uncertain. So now let's put on our portfolio manager hats and think about how we can actually manage this uncertainty in investments in fixed income. So firstly, we already know that generally bond prices and yields or interest rates are negatively related. We saw this in a discussion that we did previously, but there's two important dimensions to this. First of all, longer-term bonds are actually going to be more sensitive to interest rate changes than short-term bonds. Now, the intuition for this should be fairly straightforward. Remember, interest rates compound per period. So the more periods you have to compound, the bigger the cumulative effect of the interest rate change will be. You can think about it sort of as a snowball rolling down a hill. The longer the hill, the bigger the change in the snowball. So a small change in interest rates will affect a short-term bond less than it will affect a long-term bond. And furthermore, we saw this already, but we'll think about this in greater depth now. The changes in a bond's price relative to its yield are actually not linear, but they're convex. So let's look at an example of this in two bonds. Let's look at a 30-year coupon bond and a 1-year coupon bond. And let's say that the interest rate starts out for both of them at 10%. Now, what are these bonds worth at the 10% rate? Well, let's say that the coupon is actually at 10% for both of them as well, and now without even having to do any math, we already know both of these are par bonds. Therefore, their price when the yield is 10% should be par or 1,000 in both cases. Now, with doing a bit more math, but nothing that we should be by now unfamiliar with, we can actually figure out what these bonds would be worth if the interest rate fell to 5%. So for the 1-year bond, we just have to discount the one-time coupon of $100, as well as the repayment of principal by one period at now 5% instead of 10%. And we should get this number, 1,047. Remember, of course, a decrease in interest rates makes both of these bonds actually premium bonds, right? Because now the coupon rate is above the yield. Now the 30-year bond would be a bit more complex mathematically, just in terms of the number of steps we have to take, but we can still plot out that timeline of now 30 $100 coupon payments, the repayment of principal in year 30, discount those back to year 0 at 5% each. Or we can use that price function that we talked about in Excel in a prior discussion as well. And that shouldn't be too difficult for us to get the price of this bond at 1,768. Now, what if instead of falling to 5%, the interest rate rises to 15%? Well, we can again discount the one-time coupon payment and one repayment of principal a year down the road for the 1-year bond. Now we see that, of course, this is a discount bond because the yield is below, the yield is above the coupon rate. But we actually see that the 30-year bond falls by an even greater amount. If we discount 30 years of coupons at this higher 15% rate, and add to that one-time repayment of principal in 30 years' time, and you should do this math just to sort of verify the numbers, you should get 671.7, which means that the 30-year bond has fallen by far more, right? By about $330, whereas the 1-year bond has really only fallen by about 44. And this becomes even more pronounced if interest rates rise to 20%. The 1-year bond falls in value a bit more, to 916. So I guess the cumulative decrease in value is about $84. But the 30-year bond literally has lost almost half its value. It's fallen by about $498 if you take those 30 years of $100 coupons plus the repayment of principal in year 30, discounted back to year 0 at 20%. That present value is now drastically lower. So this shows that maturity actually strongly affects how the price of a bond relates to its yield. The longer the maturity, the greater the variation in prices. As yields change, the shorter the maturity, the smaller the variation. The 1-year bond doesn't really oscillate too much. The 30-year bond can go up by about 70% or fall by about 50%. And furthermore, you can already see the idea of convexity here. We see that the relation between the bond's values if the interest rate falls versus if it rises is not linear. It is actually convex. So the bottom line is that longer-term bonds have much greater price variation due to interest rate changes, and therefore we can say that they have greater interest rate risk. Now, another way to conceptualize this with zero coupon bonds is to look at price changes for a 1-year zero coupon versus a 2-year zero coupon. So again, a difference in maturities. One of them is a longer maturity than the other. And let's say that yields start for both of them at 6%, but then they can either drop to 5% or rise to 7%. Well, we should already expect that the relation between yield to maturity and price is going to be negative, of course, but let's see just how negative. Let's look at the 2-year bond. Let's say that the yield falls from 6% to 5%. In other words, we discount a payment of $100 face value at 5% instead of what it used to be discounted at 6%. If we discount it at 5%, its present value should be 90.7. If we discount it at 6%, its present value should be 89. Therefore, a drop of 1% in interest rates leads to a $1.70 increase in the price of the bond. Now what about an increase in interest rates? That same 2-year zero coupon bond that used to be worth or had a present value of $89 when you discount it at 6%, now will have a lower present value when you discount it at 7% of 87.34. In other words, it falls in value by $1.66. So this sort of more formally accentuates the idea of convexity, because the price change in the bond is actually different for an increase in interest rates than for a decrease. For a decrease in interest rates, the bond price rises by more than it falls if interest rates increase by the same amount. Therefore, we call this a negative convex relation. Now, maturity, of course, matters. So if we look at the 1-year versus the 2-year zero coupon, and we increase the interest rate from 6 to 7%, the 1-year zero coupon goes from being worth 94.34, the present value of 100 discounted for 1 year at 6%, to 93.46, the present value of that same amount discounted for 1 year at 7%. And if we take the holding period return, that would actually result in a negative change of 93%. In other words, here's what the bond is now worth, here's what it used to be worth. The price changes 93% down. Now if we take, instead of the 1-year bond, a 2-year bond, and we already know its present value at 6%, it's $89. We discount $100 face value twice at 6%. What if we instead discounted at 7%? Well, we did that number already. It should be 87.34. The price change is almost double, actually, at negative 1.87. So longer maturity bonds, whether they're zero coupon or coupon bearing, are more affected by changes in the interest rate than shorter term bonds. And these interest rate changes are convex, so bonds price will change more if interest rates fall than if interest rates rise. So now that we know that bond prices will change with respect to interest rates, let's actually come up with a measure for the sensitivity of a bond's price to interest rate changes. And what this measure is duration. And this is one of the most important measures in fixed income investing, especially when it comes to managing a portfolio of bonds. So duration is, you can think of it as an average time you have to wait for your payments. Why would we consider this to be useful? Well, we know that maturity matters, right? So if we can sort of conceptualize how long you have to wait for your payments, that should mathematically capture how sensitive a bond is to interest rate changes. And we may want to weigh both coupon payments and principal payments. So we shouldn't just base this on maturity entirely. We should figure out the effect on coupons as well, if any. So let's look at two bonds, A and B. How long do you generally have to wait to actually get your payments? Well, for bond A, this should be fairly straightforward, right? You just have to wait 4 years. There are no intermediate payments. You get nothing in years 1, 2, or 3. You get your full repayment of principal in year 4. So the average amount you have to wait for your payments is, of course, 4. But the reason that we wouldn't want to just say that the maturity is really what drives the duration for bond B is, the same way that maturity actually is equal to duration for bond A, is because of these intermediate coupons. In other words, you get some of your payments earlier, and therefore the average amount of time that you have to wait for your coupon is actual, or the average amount of time you have to wait for your overall payments should be less for a coupon-bearing bond than the full maturity of that bond, simply because you do get some of your payments early. And in fact, the more you get in coupons up front, the lower the duration of that bond would be. So now let's actually derive the formula for duration. Let's begin by simply writing down the formula for the price of a bond. We know that the price of a bond is the present value of its discounted cash flows. We're going to discount them at the yield to maturity, as of course we've always done. And let's say this is a bond maturing at time t, so we've got annual coupons for each year, including t, and then we have the repayment of principal as well. But if what we're trying to do is trying to get the sensitivity of the bond's price to changes in yield, let's take a derivative of this expression, the price of a bond, with respect to yield, here in the second line. Now, we're literally taking a derivative of both the right and left-hand side of the equation with respect to y, the yield. So the left-hand side is clear enough. It's just change in price with respect to change in yield. Whereas the right-hand side isn't too much more complicated once you see what's going on. Remember, these discount factors that we have in the first line are essentially the same thing as multiplying the cash flow by 1 plus y to the negative exponent. Because mathematically, 1 over 1 plus y to the negative n is the same thing, or sorry, 1 over 1 plus y to the n is the same thing as 1 plus y to the negative n. So if we take a derivative of 1 plus y to the negative n, we move the negative n out front as a coefficient, and we subtract 1 from that negative exponent. So instead of negative n, we get negative n minus 1. So let's look at the case of that first cash flow where we have CF1 effectively times 1 plus y to the negative 1. If we take a derivative of this expression with respect to y, well then what we get is negative 1 out front times 1 plus y to the negative 2. And then if we again represent that instead as 1 over 1 plus y to the 2, that's exactly what we observe for this first term. For the second term, it proceeds analogously, so we have cash flow in year 2 times 1 plus y to the negative 2, which is analogous to this expression. And if we take a derivative of that with respect to y, we get the negative 2 out front as a coefficient. And instead of getting 1 plus y to the negative 2, we now 1 plus y to the negative 3. In other words, 1 over 1 plus y to the third. And we can proceed like this for all of the cash flows all the way up to time t, where we used to have the cash flow at time t times 1 plus y to the negative t. We move the t out to the front as a coefficient, subtract 1, making it 1 plus y to the negative t minus 1, or 1 over 1 plus y to the t plus 1. Now, if what we're trying to produce is an elasticity, we actually know what from economics what the mathematical formula for elasticity is. We can get that over here on the left-hand side that involves the derivative, but actually is the elasticity then of the price with respect to a change in 1 plus the yield. But how do we mathematically create that from what we had on the right-hand side of the equation preceding this? Well, if we want to get this elasticity term on the left-hand side, it looks like we need to take our left-hand side of the second line, and we need to multiply it by 1 plus the yield. So I guess we better multiply both sides, the left and the right side, by 1 plus the yield. And if we do, of course what that does is it reduces the exponent of 1 plus the yield by 1 in all cases. So we go from 1 plus the yield to the second, third, and so on to t plus 1, to instead 1 plus the yield to the first, second, and so on to t. And the other thing we need to do to create a measure of elasticity is divide by p. So let's divide both sides of line 2 by p as well, which literally just means adding a p to the denominator of each of these fractions, like so. So now we've actually accomplished what we have set out to do. We've derived a formula for the elasticity of the price of a bond with respect to a change in 1 plus the yield, and it looks like this. Now what is this? What is actually in these orange boxes here? Essentially, we've got, I guess the last trick we need to do is to cancel out the negatives, essentially multiply both sides by -1. So now we've got the negative elasticity on the left-hand side. And now we've just got coefficients 1, 2, all the way through t, positive, multiplying these orange boxes. Now what are these coefficients? Well, if you notice, they're actually the maturities at which the cash flows occur. So cash flow 1 occurs in year 1, it's got 1 year to go. Cash flow 2 occurs in 2 years, it's got 2 years to go. Cash flow t occurs in t years. So it looks like we're taking the maturities at which these cash flows occur, and we're weighting them by something. Now, what are we weighting them by? These are these orange boxes. Well, we're actually weighting them by the relative proportion that each cash flow represents of the total price of the bond. Because if we break up this three-term cash flow 1, P, and 1 plus y to the first, we can break this up into two components. We've got cash flow 1 over 1 plus y to the first, that's the present value of cash flow 1, divided by P. In other words, what proportion of the total value of the bond does the present value of cash flow 1 represent? Analogously, we can here in this box see that what this really represents is what portion of the total value of the bond, total present value, its price, does the present value of cash flow 2 represent? Because this is again cash flow 2 discounted to present value over the price of the bond. And so on all the way up to maturity T. What does cash flow occurring at time T in present value terms represent as a proportion of the total present value of the bond? So the weights are effectively the proportions that each cash flow represents of the bond's total value. So we can think of this then as sort of a weighting of maturity by proportion of the cash flow as a total of bonds value. In other words, what's the relative contribution of that period's cash flow to the overall value of the bond? So this is why we're saying that essentially duration is sort of like an average time that you have to wait for your payments, because we're literally taking the time to each payment and we're weighting it by the importance of that payment relative to the total. So now we have a formula for duration. We see that it's the negative elasticity of the price with respect to yield, or well, more technically, 1 plus the yield. And the way that that quantity is actually calculated is a summation of the weights of each cash flow times the time that the cash flow is occurring, summed up across all cash flows. Remember, the weight for each cash flow is essentially the proportion that that cash flow in present value terms represents relative to the total price of the bond. In other words, the duration is the average of cash flow times weighted by the contribution to the present value of the bond of those cash flows. Now, what if we actually want the price change? We have an elasticity, but now let's actually think about what we might want even more, which is a change in the price of the bond relative to the bond's initial price. So remember, our elasticity formula was duration is equal to negative change in the bond's price over the change in yield times 1 plus the yield over the price. So how do we turn this expression into this expression? Well, let's simply shift over the price in the numerator, sorry, in the denominator, from one fraction to the other. We can do that without really changing much at all. And then what we will end up with is duration is still equal to negative change in price over price times 1 plus the yield over the change in yield. That's sort of a sloppy delta, but you get what I'm getting at. And now all we need to do is just solve for this term here. So in other words, we need to move this fraction 1 plus yield over delta yield to the left-hand side of the equation that has the duration in it. And we can do that by multiplying both sides by delta y over 1 plus y. And if we do that, this is exactly what we get. Now, let's separate that out into also two components. Let's take the d over 1 plus y. We're going to call that modified duration. We also need to bring the negative over because we don't want the negative change in price, we want positive. So we'll bring the negative over to the other side of the equation by multiplying both sides by -1. So now we have the modified duration, where we've taken our original duration measure, rescaled it by 1 plus yield, times the change in yield. That gives us a linear function for the price response for a change in yield. In other words, the bond's change in price rescaled by its original price, sort of like a return, if you will, is the negative duration rescaled by yield, which we call modified duration, times the change in yield. So how does that actually look? Well, we know that this representation is going to be linear, right? We just worked out that the price response is going to be linear in changes in yield, and the coefficient is going to be this negative modified duration. So that means that if we have a 30-year bond, and we actually calculate its present values for different interest rates, we can compare that to what the linear prediction from this duration relationship that we just worked out would be like. Well, we can see that for small changes around 5%, which is our initial yield, it's actually quite good. In other words, in this region here, the deviations aren't very great. But remember, there is this issue of convexity. In other words, bigger changes in yield produce different changes in the bond's price depending on the direction. Bigger changes for decreases in yield, smaller changes for increases in yield. And that means that the farther we deviate from our starting point at 5% yield, the bigger the discrepancy between our linear forecast for the change in bonds price from duration is to the truth, which is the actual present value of the bond once we work out the math. So this is something to keep in mind. The linear approximation for the price change of the bond is not going to be perfect, but it's certainly a powerful result. So let's actually look at an example of a duration calculation real quick. Let's say we've got a 4-year coupon bond with a face value of 1,000, a coupon rate of 8%, and a yield to maturity of 10%. Well, what is the price of this bond? By now, this should be old hat to us. All we do is take the cash flows occurring in each of the 4 years, discount them at the yield with the appropriate exponent, and the price of this bond is 936.6. Now, what is the duration of this bond? Remember, since the duration essentially weights maturities by the proportion of each cash flow relative to the total value of the bond, that means that we need this present value of the bond, its price, as an input. So what are these 4 weights? We're going to weight the year 1 by the proportion of the year 1 cash flow relative to the total. Year 2 cash flow, we're going to weight the maturity of 2 by the proportion of that cash flow relative to the total. For year 3, we're going to weight this cash flow as proportion relative to the total. We're going to use that, I should say, as the weight for the year 3 maturity, and same for year 4. So what are the weights? Well, for the 1-year maturity, the present value of that cash flow is 80 over 1 plus 10% to the first. And that is 7.7% of the total present value of the bond. Therefore, we're going to weight the 1-year maturity by 7.77%. What about the year 2 maturity? Well, that represents 7.06% of the total value of the bond. So we're going to weight the year 2 maturity by a slightly lower 7.06% weight. Analogously, we're going to weight the 3-year maturity by that proportion that the year 3 cash flow represents as a fraction of the total value of the bond, 6.42%. And of course, since this bond pays off most of its total cash flow in year 4, which is the repayment of principal, we shouldn't be surprised that the weight that is assigned to the year 4 maturity is the greatest at 78.7%, mostly because the present value of this last cash flow is the vast bulk of the total value of the bond. So now working out the duration formula as literally each weight times each maturity summed up, we see that the duration is 3.56 for this bond. As a sanity check, should we expect this as a result? Well, we can easily put an upper bound to what we could expect the duration of a 4-year bond to be, right? It can't be more than 4. And in fact, we know it should be a little less because this is the coupon-bearing bond, so you get some of your money back a little bit earlier, which means that the duration of this bond should be a little bit less than 4. If it were a 0 coupon bond, its duration would be 4 exactly. So now that we know the duration of this bond, let's actually see if we can forecast its price change without having to work out the entire present value calculation all in advance. So remember, since we saw in that plot of the linear forecast versus the truth, we see that for big changes in yield, I should say, the linear forecast of price change from duration is far from perfect. But for smaller ones, it looks like it's going to be pretty close. Well, let's see what it would be like for a small one, an increase in yield from 10% to 10.01%. We're going to use our expression that the change in the price of the bond with respect to its original price is going to be approximated as the negative modified duration, where we're just going to take our duration, rescale it by 1 plus the yield, times the change in yield. Now remember, for the modified duration, we're going to use our original value of the yield, so 10% rather than 10.01. We know what the duration already is, 3.56. We're going to rescale it by 10.1, and the change in yield is 1 basis point, 0.01%. So now all we're actually doing is taking negative 3.56 over 1.1 times 1 basis point, and going through the algebra, we get negative 0.032%, or 3.2 basis points. Now, one might think that, okay, longer maturity bonds have greater duration, of course, simply because their cash flows are spaced over a longer period of time, even if they're coupon paying. Does this mean that then longer duration bonds are more risky? Because generally we see that linear relationship between price change and duration. If duration is bigger, is the price change always going to be bigger. So our longer duration bonds generally more exposed to interest rate changes than shorter duration bonds. Well, the intuitive answer might be yes, of course, the coefficient is greater, but actually it's not necessarily the case, because the other factor that actually determines the price response is the magnitude of yield changes. And one thing that we saw in that plot of term structure changes for interest rates from the Financial Times, if you remember, the short horizon interest rate was oscillating way more than the long horizon one. Remember, we started with sort of an upward sloping term structure, and then at some point the short-term rate started creeping up, and the long-term rate didn't really change too much. Eventually we ended up sort of with a hump shape, where the long-term rate did come down some, but we saw the short-term rate oscillate far more. So that means that you may actually have bigger yield changes, even for shorter duration bonds, that might produce a bigger price response, simply because there's two moving parts that determine the price change of the bond. The duration, which is greater for long maturity bonds, and the change in yield, which might actually be greater for short maturity bonds. So not necessarily. Short duration bonds can actually have substantial exposure to yield changes as well, mostly just because there's bigger changes in yield possible. But putting yield changes sort of on an equal footing, then of course having a longer duration does make for a greater exposure to those equal yield changes.